yet another instalment of our Nucleus Wealth Insight series. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com. So, hello and welcome to our next instalment of Nucleus Insights, and it's a follow-up called Quant Rocks for selecting stocks. So this is the second of a three-part series, and today we're looking at the quality side of quant investing. I've got with me here our Head of Investments, Damien Klassen. Welcome, Damien.
Hi, Tim.
And we'll jump into it. So, quick agenda for today. So we're going to start with a quick refresher on quant investing, and just for those who perhaps haven't caught our first introduction webinar, we'll be then moving into what entails in the MSCI and quality within the stocks in the MSCI index. We'll then look at the overlay of how we view quality at Nucleus Wealth. And then finally, a bit of a run through of where quality works and potentially doesn't work. So on that note, we'll take it away. Thanks, Damien.
Yeah, sure. So yeah, just the sort of quick thumbnail sketch of the prior one was that quantitative models are there. They're mathematical models that are going to help generate stock performance and investment performance, but the key thing to remember is they don't always work, but they usually do. This isn't a religion. This is something where you need to look at what they're there to try and overcome some of the behavioural issues that people have in terms of falling in love with stocks and falling out of love with stocks and hating stocks, and sort of it's there to have your models throw up the numbers and say, look, I know you like this stock and you bought it because it was cheap, but guess what, it's not cheap anymore, and I know you're really happy with it because it's up 50%, but you've got to sell it because you bought it because it was cheap and not particularly good quality, and now it's not cheap, so your model's telling you to sell it, and whereas when you buy stuff, it's often you often fall in love with it, and especially when they perform well, or they're stocks that people consider are dogs and always dogs, and these quant models can start telling you, yeah, look, it was a dog and it was things were never good with it, but the quant signs are, or there looks like there's things that are improving, and it might be time to go back and have another look.
So I guess broadly speaking, it's a data-driven analysis metric for stock selection.
Yes, and then the way we use it is that then we say, well, the data-driven is great because it overcomes a lot of inherent biases that people have.
Sure.
But then you absolutely need to put the fundamentals behind it and actually get in there and open the hood up and have a look at why the models like these, and that's one of the big things I was going to come through to this as I go through the whole thing is it always needs to come back to why does the model like this, or why is this model telling me that to buy this stock, because quite often they give you the wrong answer. In aggregate and as a total, you get the right answer, but you need to buy lots of stocks for that.
Yep.
And so, especially for retail investors, if you're only buying a few stocks, you want to spend a bit more time to make sure that it's not being they're not throwing up the names for the wrong reasons.
And just quickly as well, I guess, and just continuing on our recap. So, obviously, having been in the investment world for many years. What's the draw card, I guess, of quant over, say, a number of other strategies, and do you see them? Is it more regularly used in the industry? Is it something that you really need to have your head around if you're going to employ it effectively?
Yeah, look, I think quant went through a bit of a period where in the 2000s where it became sort of the flavour of the minute, and you got a lot of quant funds starting up and chasing similar types of returns. And then there was a bit of a quant crash in 2007, 2008. We sort of had a number of quantitative funds all basically chasing the same strategy, which all fell quite dramatically over the same period.
Okay.
And that sort of led to an exodus of money from the industry. The quant funds that did better were the ones that weren't sort of chasing the same returns and weren't the mechanical. My model tells me to do this, I go out and do it. Here's a stock which I have to buy because my model tells me, and I don't care what they do or anything. It's just this is just a number on a page.
Sure.
They were the ones that had the biggest problems.
Okay.
Some of those are back.
Yep.
and so quant performance has been pretty good, and there's a lot more of a flow into quant now, and a lot of it is this what's called smart beta, which is what we'll move on to with the MSCI, but it's largely predetermined formulas which tell you what stocks to buy. And I'm just going to run through some of the dangers of that because things change, and so and where they, you get these nice looking. You never see a bad back test in quant land, because if you do a bad back test, well, you throw that one away and you go run another one until you get a good one.
Go and do a few more. Fair enough. Yeah. Looking forward to that. And then just finally, we've got a line there. This is an implicit assumption about non-reversion. I think that probably warrants a small bit of explanation before we keep going.
Yeah, sure. So, and I've actually got a whole slide on this, but it's worth remembering that, and we're about to look at. This is talking about the quality side of it, is that whatever quantitative method you're using, you have an assumption about why you're using that method. So, for example, if I'm going to buy cheap stocks, if I'm buying value stocks, there's an assumption that they will revert at some stage and I'll make money out of that. So I'm buying them when they're cheap, and whether it takes a year, 2 years, 5 years, eventually it will revert to a higher number and be less cheap, and I'll make money from it.
Okay, sure.
In quality investing, you're actually making the opposite assumption. You're making the assumption that this company is good quality and it won't become average quality.
Right. Okay.
And so, and so it's an assumption that is true over sort of medium periods, and I think over quite long periods, it can prove to be false. Is it, say industries that have good returns and attract other competitors, and then other competitors come in and beat those returns down and things like that. So it's an important assumption. It's important to know that we're making this assumption whenever we buy quality stocks. We're making an assumption that it won't revert, and so the thing we're going to be looking at all the time is this going to revert? Because that's the
that's the danger.
That's the danger, is that you buy something that's a BlackBerry, I'll use or a Nokia, I'll use an examples of, look like very high quality stocks and had these products that everyone used, and it was like, for anyone who, the millennials who don't even know, there's Nokia.
What a BlackBerry is.
Well, yeah, that's right. Or Nokia's used to be, this very simple phone that you give to your grandma because it was so simple and so easy to use
and indestructible.
And they were, a huge market share, and then all of a sudden smartphones, and 3 years later there was no such thing as Nokias anymore.
Sure.
And BlackBerry went through the same experience, and so what looked like very high quality companies, and you're buying them saying I'm buying this because it's getting great returns on equity and it's always going to have great returns on equity, is the assumption was, well, no, the assumption is wrong, and so you need to be aware of those ones.
Okay, sure thing. All right, so I guess that we've got here, number one question is, are you selling insurance to the rest of the market? So
so whenever you're running a quantitative strategy, you need to think about why you're making money from that. So there's a good book out by Nassim Taleb called The Black Swan, and he goes into a lot of different strategies there that basically make a little bit of money every day, and then all of a sudden blow it all up in one go. And basically what you're doing is selling insurance to the rest of the market. So as an example, if I if I sold house insurance to people who lived around me and things like that, it's a fantastic, it feels really good, because every day or every month, I collect a premium from all these people, and it's like, $100 here, $100 there. Doesn't this feel really good? I'm making money all the time, and how consistent is this money coming in?
This could go on forever.
And all of a sudden somebody's house burns down, and I'm up for $400,000 to replace it, and I'm sort of sitting there going, well, just a minute, I only made 50 grand. It felt really good while I was making it, because it came in steady money every month, and isn't that great?
Yep.
But you need to know what am I hedging against, and there's a lot of quantitative strategies that are similar in terms of you're providing liquidity to people who are basically or providing some sort of insurance type payment. You're getting a premium for investing in some factor, because other people don't want to invest in that factor because they know every now and again it's going to blow up.
Okay, all right,
and so,
interesting.
and so those ones, they're the strategies which feel really good when you're doing it, because it's the same thing. Every day I'm picking up $1, I'm picking up $1 here, $1 there, $1 there, $1 there, and then next thing you know, I'm down 10,000. And it's like, well, all those little dollars that felt good didn't actually add up to the amount that you lost.
That doesn't sound ideal. Yeah, sure. All right, fair enough. And so then, as you touched on before, so the implicit assumption, and we've got a list here.
So I've got five of the key quant strategies that we ran through before. So momentum is the first one, which is basically, and I always feel a bit embarrassed about this one. It's one of the best factors there is, which is basically you buy whatever went up and it keeps going up.
Okay. Yeah,
and obviously this doesn't work it doesn't work forever, but it works more than it doesn't work. And which is why technical analysis and a whole bunch of other things also have this factor. And so what you're assuming there is there's no mean reversion. You're saying I'm buying what's going up and it's going to keep going up forever. Obviously that's not going to happen, but there is your key underlying assumption when you're running a momentum strategy is there's no mean reversion. So you keep needing to be testing it for saying, well, when will the pullback happen.
Okay, sure.
Yeah.
Yep.
Low volatility is the same. So low volatility is a strategy where you basically buy stuff where the stock price is not volatile.
Okay.
And that tends to outperform. Growth is buying growth stocks. Now that's not such actually that generally speaking, growth stocks don't actually outperform as a group. So you're buying stocks there that are generally. They're priced for the problem is not that they don't grow. The problem is usually that they're priced for bigger growth than what they actually get.
So the market sort of overstates the actual overpays. Yeah. So overpays the opportunity that the company's going to provide. Okay.
Yeah. Then value is the mean reversion, or the key of these five is the key one where you are betting on mean reversion, and quality is no mean reversion. So we run a mix of quality and value strategies.
Okay.
We do look at low volatility as part of our quality measure. We look at momentum just in terms of timing and sort of negative signs, but they're not sort of key measures for us. We mainly look at value and quality, and so we are making, as we're doing that, we're sort of making two different reversion bets.
Okay, all right, fair enough.
So into quality.
Sure. So to kick yourself, you've got here for those listening in the podcast, but essentially it's a graph from 2003 of the MSCI World versus what I take it is the MSCI World with a quality element graph, obviously showing that the quality overlay is significantly better, I guess, in the long run. Definitely providing some upside.
Yeah, so you've quality in general tends to outperform over the longer term. Is the outcome that we've got.
Yep.
But the big issue always comes back to how is it defined, and that's where you get into the MSCI definitions, and it's a little bit it's a little bit simple. It's very, very simple, to be honest. So I like the trend. So the heart's in the right place. So they're basically saying we want companies that have a high return on equity. So what that means is return on equity is your profit divided by the equity that's actually been put in. So you're basically saying how much money goes into the company and what return do you get on that. So yes, that's a tick. Yeah, that's a good thing. You want stable earnings that are uncorrelated with the broad business cycle. Yep, okay, that sounds good. I'd like stable earnings and a strong balance sheet with low financial leverage. So tick tick tick. In the heart's in the right place. These sound like the types of stocks I'd like to have. I've thrown in their actual, the more technical definition, which I think will need a bit of explanation for the non-stat heads out there. But basically, the quality score for each security is calculated by combining a Z-score of 3 Winsorised fundamental variables, namely return on equity, debt to equity, and earnings variability. And why I'm doing this I'm not trying to do a stats lesson. I actually just want to show you where the problems come about this. So
Okay, sure.
So what they're basically doing is putting everything on a normal distribution, and then trying to work out where do the stocks sit within that normal distribution, and then buy the best ones.
Okay.
So you put all the stocks you rank all the stocks on return on equity, and then you score that positively, and then you rank all the stocks on debt to equity, and you score that, and then you rank the stocks on earnings variability, and you score that, and you add you add those three scores together, and then rank them again, and come up with the best ones.
So essentially you're deriving the quality aspect into sort of three categories now, and then giving it there's more granular, I guess, sorting, for want of a better word.
Yeah.
To say that you've got, rather than just being a good quality company, it needs to be good on three fronts essentially to be.
Which is not very many.
Yeah. Okay. Well, fascinating.
From mine, I like to look at hundreds of different ones. Obviously, there's some that I weight quite highly, and others that I don't quite weight highly. There's no cash in that thing, so you can have a company reporting great earnings, and it doesn't appear in this list because, we're reporting great cash flows. Earnings might not be as good, but or other companies with reporting very high earnings, but there's just no cash behind it because it's all paper money.
Yeah, okay, sure.
They show up quite well on this. So there's lots of different things that don't get included. But let's jump into the return on equity as a first one. So,
yeah, okay, great. So we've got a chart here of I think the IBMs.
IBM.
Yep, IBM. What, over the last sort of 15 years or so?
So it's actually 2006 to 2016. So I've cut it off.
Okay.
And IBM over that time went from being having hardware, and it went to being a service company. So now the key focus is on IT service.
Okay, sure.
So it's much less capital intensive. So what that meant was they didn't need as much capital. They could give a lot back to shareholders.
Okay.
They also did lots of buybacks and lots of write downs. So we're looking at the return on equity going from 20% in 2006 to over 100%. I think it peaked at roughly.
Wow. Yep.
In terms, and just to put this in context, so what this is telling people is, for every dollar they put into their business, they get another dollar back effectively the next year.
Wow. Yeah. Okay.
Which is not right. And the reason why, it's because accounting issues are happening behind. So return on equity is your net profit on the top, divided by the amount of equity on the bottom.
Sure.
Now the profit actually didn't do too badly over the time for this one, but the big issue was that equity got eaten away. And so because of the buybacks, because they were less capital intensive, because there were some write downs, some accounting standards changes, things that went on, all of a sudden this equity number, so that the return on equity shot sky high, not because the profits shot sky high, but because the bottom of the equation fell away.
Yeah, gotcha. Okay, fascinating.
And so and so what that meant is that this company looked like it was, at face value, this ratio is telling you every time they stick a dollar back into the business, that they make
another dollar pops up.
Another dollar pops up the next year. Yeah, and then they keep on earning that forever.
Yeah, sure.
And we know that's not right.
Yeah, okay.
And so these ratios can mislead you. The other thing then is, so then if we jump forward to the next period, is
so now we've got the same chart, but now from the last couple of years.
Yeah. So now we've gone back from 100% all the way back to 20%, which is still a great return on equity. No complaints about 20%. But what it's obviously telling us is that there's serious problems with this ratio for this company. And you can't just screen on this one ratio
and then tick a box and say off you go, invest.
So this thing's done. And the other thing is they do use non-recurring items as well, which is there's certainly so they strip out anything that's non-recurring, which I agree with in principle.
Sorry, just what's an example of a non-recurring item?
Yeah, that's a very good point. So what happens with companies is if you company's earning money and it looks at one of its divisions and said, this division's not worth what it used to be. We bought it for $1 billion. Now it's only worth 500 million. We're going to take a write down of $500 million.
Okay.
And so what most analysts will do is they'll say, well, okay, there's an issue behind that, and you've lost money, but in terms of valuing this company going forward, well, you're not going to lose that 500 million every year, so I'll exclude that from your calculation and let's go.
Okay, sure.
The problem is, as soon as you tell companies that, hey, we're going to exclude some of your earnings, they come up with a laundry list of all these other things that they would like you to exclude.
Okay, yeah,
so
right.
So they're telling
sort
you
of kitchen sink it in a sense.
Absolutely, they're telling you, hey, you know, we made $10 billion this year, but it really should have been 20 because if you exclude this, this, and this, and this, and you know, and restructuring charges is the key one that, you know, that's usually the worst one that you see, because all you do with the restructuring charges, you say, hey, things aren't going that well. I'm going to take a big write down on XYZ division. I'm going to write it down by whatever $300 million, and as a restructuring charge, one off, you can ignore that 300 million and then let's go on again. And what really happens is the company takes a big hit of the 300 million,
sure,
but they haven't really spent it yet. They're going to spend it.
Yeah, right.
Now they just start doing redundancies and all that. So they actually spend that money, or they get spent over the next 3 years.
Yep.
And then lo and behold, we take another write down, another restructuring charge. You know, restructuring always happens.
Yeah, right.
And other companies will write off legal costs within this, and they go, oh, you know, we had a class action against us or whatever. And it's like, well, yeah, look, you know, you're in the business of selling whatever, health solutions and all that. It's going to happen sometimes. Maybe you should smooth it or whatever, but you shouldn't ignore it.
Yeah, okay.
And so you see that all the time. Companies just keep saying, oh, this, you know, and it's always the, you know, it's never the good luck ones. It's always the bad luck ones that get thrown in there. Well, it's not never, sorry, but you know,
more often than not.
More often than not, it's explaining why this big negative should be ignored, whereas the big positives from whatever wins somewhere else will just get, you know,
posted straight away.
Posted straight through.
Yeah, sure. Okay, very good. And then moving into the debt side.
The debt side. So yeah, again, a very simplistic measure. They basically look at total debt divided by equity. So you've got exactly the same problem that you had with equity, is that you're using the book value of equity, and so all of a sudden the debt might look too high or too low. It doesn't. It looks at total debt, so it doesn't include if a company's got $1 billion worth of debt and $700 million worth of cash, it'll look at the $1 billion worth of debt, ignore the $700 million worth of cash.
Oh, right, okay.
So, which again, you know, is one of those ones where I like to look at both. Like, it's sort of that. It's when you're trying to ascertain quality, you want to look at as many different facets as you can. So you want to be able to look at a company and go, yeah, it looks like a problem with debt. Oh, but actually, if you take out the net debt, looks all right. Okay, now let's go and make sure the net debt is real, and you know, let's go and have a bit of a closer look. But whereas this one just says, no, you use the one measure.
Debt is debt.
Yeah, and the issue with using equity in both this calculation and the prior calculation is that accounting standards change over time. And in particular, over the last sort of 15 odd years, there's been a switch in accounting standards to encourage write-downs, but you don't get but not write-ups in value.
Okay.
So whereas, you know, 20, 30 years ago, you revalue assets up and you revalue them down depending upon what you thought. Now the emphasis is very much on the negative side, is that there's downward revisions, but the rules over upwardly revising are pretty
relaxed,
are a bit more stricter, and so people don't do it.
Oh, okay. And
so what that means is for your equity is that there's versus where it was before, there's now a bias for that number to be lower than what it would have been in the past if you're reporting on the same. So that sort of keeps changing. And so what that means is if you've set up these quant strategies saying, here's my magic formula, I'm using 3 different things, I plug them into the calculator and that throws out those stocks that are going to perform, is saying, well, yeah, that worked over a period where you're using a certain accounting standard. When the accounting standards change,
you should change the methodology, essentially.
Exactly.
Yeah, okay. Yeah, right. Fair. Yeah, well, that's fascinating.
And then the last one they use is the earnings variability. So again, coming back, I just want to reiterate, all these are good. You know, the idea that getting a good return on equity is a good company, I agree with that. It's just if you use a very simple definition, it makes it harder. If you think that highly geared companies are dangerous and they're not high quality companies, yes, that's right. But if you're using a single measure and that measure is a bit flawed, then there's an issue there. And the final one, this earnings variability, absolutely. You know, companies that have quite stable earnings and all that type of stuff, we absolutely want them. How they do that is they do a standard deviation of earnings growth. So that's a relatively, you know, simple calculation. The big issue is they only use 4 data points. So, you know, and so you speak to engineers or doctors or, you know, anyone who, you know,
with small sample size issues, it sounds like it'd be a very big problem.
yeah, exactly. So if I said, oh, look, you know, I've been testing this drug on people and I've got my standard deviation of results and it's quite tight and it's, you know, so I'm pretty sure this is working really well. And they go, well, how big's your sample size? And you say, well, I tried it on 4 people. You know, you laughed out of the thing. But whereas here we are buying stocks based on the fact that the earnings variability is low, based on 4 numbers.
and who selects the numbers, I guess, is the other question.
Well, it's 5 years of annual return. Five years of earnings growth is all it is. 5 years of earnings growth. So because you've got 5 years, you have to get rid of a number because you've only got 4 actual 4 actual growth periods, and just a simple standard deviation.
Wow.
So the other thing is a positive surprise is negative is a negative on this when you do this. So if you have a company that goes, we've grown 5%, 5%, 5%, 20%.
Yep.
Goes, oh, earnings variability.
No good.
That's no good.
Yeah. So it works to the upside and the downside. Yeah. Okay. Sure.
So I agree that with this, and what I guess what I'm saying is when I'm trying to do these earnings variability ones, what I'm trying to do is try and test it a bunch of different ways to say, well, that there's one way. You want to use a whole bunch of whether we're losing analyst forecasts to give us more periods and seeing how volatile analyst forecasts are over longer periods, over shorter periods. You're looking at trends, you're looking at deviations from trends. So sometimes if you do a standard deviation of earnings and you go, earnings are sort of growing nicely, but it's an upward trend or whatever, this might show a higher standard deviation than versus trend lines. And the other thing is looking at those negative surprises, saying, well, I don't mind as much if a company always grows at 7 or 8%, and every now and again it gives me a 15. But I do care if it always grows at 7 or 8, and every now and again it gives me a 0. Yep. So so factoring in those, which this one doesn't do.
Okay, sure thing. That's great. And then the
last one.
Yeah, the last one being Winsorising. Yeah. So I'd be interested to know where this word stems from, but you might maybe chat for another time. But,
Well, there's plenty of stats stuff that you can go through in terms of that. But all Winsorising does is basically says you stick a distribution over numbers. So let's say you've done your return on equities and you stick a distribution over it, and then you basically say, look, there's some funny stuff going on past the 95th percentile, so we're going to do a standard deviation, and if we put in a return on equity of 1,000% because of whatever, then we're going to throw all our numbers out.
Yep.
So we need to get rid of those outliers, and let's just treat anyone above the 95th percentile as if they were at the 95th percentile.
So essentially, it's outlier trimming.
Yeah.
Okay.
And the issue I've put up there, it's an excellent way to ignore erroneous data, because usually what it means is when you look at those and you go, well, just a minute, why is a company earning 1,000% ROE? That's obvious. It's obviously not putting in $1 and getting back $100 for every dollar it invests.
Sure.
There's something wrong with the calculation, which is almost always the case. There's something wrong with the underlying formula, or there's been something funny's happened, the write-downs occurred, or whatever it is. And so for me, when you get those, that's the point. That's the part where I'm going, well, let me go and find out why that number is, and let's adjust that number to get that number right, rather than just saying, I've got bad data, I don't know what's going on, I'll just ignore that.
Sure. Yeah, fair enough. Okay. No, very good. So then moving into, I guess, the way that Nucleus adopts quant strategies.
Yeah.
And, so we've got a couple of definitions there.
I've got 5 different things I just want to run quickly through, and these are just different facets that we tend to look at. So first one, economic moat.
Excuse me.
And so you would have, this is a Warren Buffettism, but the idea is we're looking for stuff that's got high margins and sort of, it's got some sort of, in terms of quality, it's got something that's actually a buffer zone. So, it's above its competitors. Things can get a little bit worse, and it's not the end of the world for it. Whereas if you haven't got any buffer and things get a little bit worse, all of a sudden you're into a sort of danger zone.
So this is essentially the sort of companies that have got that sort of cutting edge, or they've got a proprietary aspect.
Actually, I might move into more details. I probably should just summarise these ones quickly, and then we'll jump in. So we've got an economic moat, which is sort of how well you sit versus competitors. Economic trajectory, just making sure that that's still headed in the right direction, that it's not, you're not at the sort of peak of your cycle.
Okay.
Stability, so you want your earnings to be stable and your cash flows to be stable, and a few other things like that. The gearing. So we don't want companies that are particularly over-geared, and then some corporate governance things. There's a few things on the corporate governance side that are red flags that sort of should give us a bit of a negative screen to companies. To throw up something we need to look at. So then I've put up a few charts just to show what our portal, things that you can see as a customer. So we give you these charts that sort of show each company where it sits in terms of quality value. So I've used Apple as an example, and so there's sort of a distribution of all the companies, and then where Apple sits within that So yeah, the top sort of in the top 10% in terms of quality, and then value sort of a little bit below that, the sort of 60 something percentile.
Yep, 57th.
In terms of value. So just to sort of show you where it sits. Then we also have that on a chart where we show where that appears versus every other company. We have this band where we like to buy things that are in the bottom. So we rank everything by quality, we rank everything by value, and then we like to buy the high quality and cheap things. The issue is you usually can't find both.
Sure.
And when you do, it's often a value trap, or something seriously wrong with the company.
Gotcha.
So it's just a matter of saying, well, high quality companies I can pay a bit more for, but lower quality companies, then I need to buy cheaper.
Okay. Yep. Sure.
Now these are not magic. The formula is not magic. Like it's us coming back to this is our best guess, and we spend a lot of time then going, well, why is that company, which I didn't think was high quality, sitting there? And then you go through the bits and you work out, well, yeah, maybe it is better quality than I thought. Or
Okay.
other times you'll say, well, okay, it's got something's happening to it. There's some one-offs or something that we need to adjust for, because the quality is not as high as what you'd think.
And so essentially, I guess from our standpoint, we're using these various quant metrics to provide, essentially like a dashboard that then illuminates stocks that are looking good, or beginning to look investable on various methods, which we then employ the next sort of stage of of our own investment.
Analysts digging through,
that's right,
listening to conference calls, all that type of stuff to work out what's going on, and is this a story that we actually do want to follow up on.
Okay, sure.
The other thing is we do there's a few different factors you can do these on. So the one I'm showing here on screen is a blended version, but we also look at it just for forecasts. So if you say, okay, ignore anything that's happened in the past and let's just look at forecasts, where would it look? We throw that one on the graph, but there's other ones as well. There's a cyclical one, so we look at like a longer histories of time, because there are stocks where, particularly in cyclical sectors, where the time to buy them is actually when they're at the bottom of the cycle.
Of course, yeah.
And so you'll look at them and you'll look on traditional quant measures and you'll say, hey, this doesn't look any good. But if you look on longer term sort of smooth ones, it might come up better. And so we'll look at some of those ones, and in particular when we're looking at cyclical sectors, we'll go through and say, okay, well, if we're interested in some manufacturing sector that's quite cyclical, let's go and adjust all our numbers and smooth them out and just make sure that we're not buying top of the cycle, or there are stocks that we wouldn't have bought, sort of just fell outside our range. But if we look at these cyclically adjusted versions, then we can justify a purchase.
Yeah, fascinating. All right, sure. And then also on the quality, we've got and just as you mentioned before, the last few charts or pictures, for want of a better word, on our webinar are actually screenshots from the analyst reports that are available in the Nucleus Wealth client portal. So every single stock that client invests in, basically through the online portal, they can dive into their own portfolio and bring up these analyst reports which contain these. So that's really good, and we'll obviously we'll do a little explain a bit on those for those that are interested in checking those out.
Yeah. So then what I do then is pull that into a summary version. I've got a summary version up here where that goes into the quality and breaks it down between return on reinvestment, which is the part about how much have you invested is in the last couple of years, and how much have you got back from it, versus you're a 100-year-old company, show me your return on equity.
Okay, right. So how good's your sort of R&D in the short term? Actually paying back. It's fascinating.
And then we'll look at forecast and how good the forecasts are, corporate governance, price stability, earnings stability, gearing, those types of. And so we've got a company here where we can see the return on investment's very good. It's sort of the top 10%. The earnings quality in term is quite good. Most of the others are sort of average. And then, so that's sort of the next stage you can see okay, why is this one ranking as quality? One step further behind that, I'll then go, say the price stability, which is a little bit below average. I'll then be looking at a whole bunch of other factors below that, all these different periods, and I've just sort of shown two that, for this particular company that flashed up, the beta is a little bit high for this stock, and also the 1 year volatility is a bit higher than its competitors. So there's we measure across a whole bunch of other factors that go into that, but the negativity from that score, the slightly negative score, is coming from those two factors, and then we'll go in and dig in deeper. So there'll be stocks where the cash flow everything looks good, but the cash flow measures don't look so good. So we'll then dig back in and go, okay, well, what do we need to look for on the cash flow measures?
Okay.
And so what I'm trying to get back to, I guess I'm going a roundabout way to it, but the thing to keep remembering is we're not trying to generate numbers that create an outperformance magically by back testing and throwing things out. What we're trying to do is say, I'm trying to find high quality companies. How can I mathematically, what can I use to help sort me and to show me and to highlight when things are going wrong? And that's where these ones are. And the bottom graph I've got, and these are my views, not ones that are on the site.
So this is the investment manager view, not the client. Yeah, fair enough.
But the idea is, behind everything that goes in, I've sort of showing these lines where I've got like this is looking at just some forecast data. So the analyst forecast for shareholders' equity has just increased. So they've probably made an acquisition or done whatever. So that's taken a jump. Profits also increased, but by not as much. And so now I'm sort of looking at saying, well, my N factor has changed by whatever, and I have this system that digs back through to show me, well, what actually changed. So your return on equity is down, but it's down because your equity's up so much and your cash flow hasn't really changed.
Okay,
is the answer for this one, which is a different story to so. It's all coming back to that point, is for every single one of these, never treat them as magic factors that are going to solve my life and I'll just press a button and buy whatever stocks it tells me and I'll be on my way. But for me, it's all about, I want to know exactly why this factor's done what it's done, and then we'll either dig in, or sometimes we'll change a little bit the methodology and the way we weight things to try and get away from buying stocks we don't want to buy.
Yeah, sure. Okay. Look, and that's an excellent one. You run that one, that lower one through the other day, and it was. I guess it just gives you that visibility, doesn't it? That when you get an in, not only do you get we had the dashboard sort of parlance before, but what you can do then is just dive back through the mountains of data that sit, that are at your disposal to try and get some clarity on exactly why you've got a result.
Absolutely, and so something like an IBM, for example, in the end, the whole quality argument behind that comes back to the equity is really low. And so the question is, is that the right measure to be using? And if we just excluded anything that used equity, does it still look like it's high quality? And that's because that's exactly how I'd use this type of thing.
This system.
Just saying, tell me why this thing looks good. Tell me why the model likes it. And now we'll go back and try and work out, is the model wrong, or is it
is it actually good?
Is
it worthwhile?
So and being everyone complains about sort of a bearish outlook and stuff like that, but it's quite, for me, having models where 200 or 300 stocks with the models, the models told me, these ones look all right, and then just began to weed through. They go, no, that's no good. That one's no good. That one's no good. I can't find any reason not to buy this one. I guess we may as well put it in.
We'll put it in there. Okay, sure. Well, that's I think that's obviously an approach that's been working really well for the past year that we've been invested. So we'll jump into some explanations.
More detail.
Detail.
So that economic moat. So the key things I'm looking for that is the high margins. So for every dollar that you make, every dollar you earn in sales, that you make a high margin. Now that has to be relative to people who are in similar business models. The key problem you find with that one, if you just took it at face value, is that a company that's highly capital intensive earns quite low margins versus a company that's, say, a services company. So they're not really comparable. There's other things you can compare them on, but margin is not a good one to compare them, because otherwise you'll just end up buying all services companies. And there might be some retailers that are very high turnover and very low margin businesses that might be actually very good businesses and very stable because of the types of products they sell. But their margins look tiny because they're just selling so much and just taking a small clipper on the way through. So that it's a good one, but needs to be taken into account. The high returns, and so it is return on equity, but you've got to look at a whole bunch of other different factors, whether it be using different types of equity or market equities, or looking at cash flows, or looking at the amount of we sort of backfill an equity that if you hadn't had write-downs and hadn't had these things that went on, so how much real dollars have gone into the company over time if we build that up, and then compare that to your current profits and things like that. And then the other one is that you're actually converting your earnings into cash. Is that it's not just all paper profits and looks great in your P&L
in the accounting sort of paperwork. Okay, sure.
Right. It doesn't flow through.
Okay.
So that's the sort of the economic moat side. Then there's a trajectory side where I spent a long time looking at these marginal returns, and it's a very tricky calculation because in the end, if you're looking at a retailer and they open a new store, you want to be getting a return the next year, and definitely 2 years in, you want to be seeing, okay, what are they actually making on it? If you're looking at an oil company, they've sunk the well. They're not, you're talking 10 years before you're going to see returns on a lot of this stuff.
But then it's sort of 100% sort of profit though once it's paid off.
Yeah, but it's more about saying the manner. So you can't be looking at an oil company and saying, hey, those guys just spent $10 billion last year and they earned zero the next year. Oh,
terrible company.
Yeah, you need to be saying, okay, well, what's the time frame that I actually need to be looking over and trying to, how can I judge this company over a longer time period? Versus other ones where you want to be able to saying, well, yes, the marginal return should be happening straight away.
Okay.
You want to get decent earnings per share growth, but again, you need to adjust that for factors like buybacks and inflation. And so if I'm comparing a Japanese company to a Brazilian company, Brazil's got 10% inflation, Japanese got 0 or deflation.
Yep.
I want to make sure I'm not out there buying these Brazilian companies just because inflation's high and it looks really good.
Yep.
Also want to make sure that if there's companies out there buying back their shares, that increases EPS growth. And it's really just an accounting mechanism. They could have paid it back. Yeah, they could have. You could have paid back the money as a dividend to shareholders, and the net. And so you just need to make sure that the growth is not coming from
an artificial source.
Yeah, that's right. Okay. And clever financing.
Yep.
Not to say it's not good. Getting returns from clever financing is good, but they're limited. They don't last forever.
Sure.
You can only gear the company up to a certain extent, and you've got sort of one shot at that. And so you want to be able to say, yeah, I've bought this company because I do think the longer term growth is good, and they're actually making decent returns, and it's not all just financial leverage and alchemy to get the returns.
Of course, yeah, that makes sense. Sure thing. So into stability?
Stability, yeah. So earnings, cash flow, dividends, share price, we just look at a whole bunch of different factors and different measures and things like that to try and make sure that the company's is that the earnings you're going to get out of that are stable. They're not going to bounce up and down, or if they do bounce up and down, that we're getting in at levels we think are reasonable. It's also worth noting that the forecastability is a big one as well. So some sectors and some stocks are more easily forecast, and I think that's a good sign of the earning stability, that if management knows what's coming in the year and 2 years, whereas there's other ones where they've got no idea and analysts have no idea where the stock's going. So
and they'd be typically more your growth oriented, sort of blue sky but potential sort of stocks.
And some of the high there's ones like some of the technology sector for you've got the latest and greatest chip, and all of a sudden everyone loves you and you sell a bucket load, and then now somebody else takes over and your earnings go back down again. And so or even just you're in a building industry, and so you go through the peaks of the building cycle and the troughs of the building cycle is just knowing that everyone has this bias about things. Whatever happened in the last couple of years is going to keep going. And so if you're a building company that's been had a few good years, everyone just extends it to the sky, and then when it's going badly, they goes to the trough. So yeah,
fair enough. Okay, and finally the financials.
So the financials then is, for me, it's important to realise that financials, they're not two-sided. So I want to avoid companies that got lots of debt, but I actually don't care if a company's got a lot of cash, or actually probably I'm actually a little bit negatively. The company's carrying all this cash.
What are they doing with it?
Why is it sitting on the balance sheet? Why isn't it? Give it back to shareholders. What's it? Do you really need to carry it? And the other thing is, quantitative. If you pick the right universe of stocks, you can have backtests where you show that companies with lots of cash actually go broke more often than companies with lots of debt.
Is that right?
Which sounds weird, but it's actually more about picking the right universe. But what happens is you find there'll be sectors where biotechnology is a good one, where you say, well, if you're out trying to get some FDA approval and all this type of stuff, you're not actually earning any money. You don't have any debt because nobody will lend you any money because you haven't got anything. So you're actually sitting there with lots of cash, and you're a high risk company that could go broke because you've got lots of cash, but
if it doesn't work, it doesn't work.
Yeah, that's right. Yep. Whereas similar size company that in the same sector with debt, quite often they've got debt, so they probably actually have some cash flows and all that type of stuff. They've actually got a business model and things like that. And so so using debt on one side, I completely agree with. Is yes, we want to find companies that have got too much debt and get rid of them, but I don't want to go and benefit companies. I don't want to be out there buying companies because I'm saying, well, everything's average, but hey, they've got lots of cash on their balance sheet, so that's a good company to buy. And you're saying, well, that's not an investment criteria we're looking for.
Okay, sure.
So but you need to look at a whole bunch of things for that, whether it's various interest covers and cash covers, and I look at CDS spreads is quite interesting, which is the insurance money. So we're basically just looking for smoke.
Yep.
Some of these things, if the credit default swaps, which is basically people betting on whether companies will go broke or not.
Yep. Okay.
If all of a sudden you see prices change rapidly in that area, well, it's worth having another look. And quite often you can see some movement in that before.
Bit of canary in the coal mine sort of thing.
Yeah. Before you see it in the equity.
Sure. Okay. I guess that's the end of how we look at the quant methods, I guess, and a little bit of info there. And we'll jump into our final segment, which is, and I think this will be fascinating, where quant works and where it doesn't.
And doesn't work.
Some pitfalls. Yeah. What are we? We've covered off on a few different areas, but potentially doesn't. Yeah. Yeah. But return disaggregation. That's an interesting one.
Yeah. That's the thing that everyone loves to take credit for things that go right, and things that go right was because I was a genius, and things that go wrong was because I got unlucky and something else happened, and so it's important to get back in behind the returns and actually say, well, why did that happen? So there's say low volatility strategies is one example of a quantitative strategy where you buy things that have a low volatility, and that's been a great performer for the last 15-20 years. And so it's worth disaggregating that and saying, well, part of that return though came because we're in falling interest rates. Interest rates started at 20-something% and we ended up at 0 in many countries around the world. And so you need to recognize that the low volatility stocks were some of the stocks that benefited the most from that, because they were the ones that were the interest rate sensitive stocks.
Sure.
And
okay.
So they sort of went from a yield of 20% to a yield of 3 or 4%, and so that sort of drove performance for them. And so I guess what I'm trying to do from the disaggregation is look for other reasons as to why this story might have worked, because obviously interest rates might have fallen from 20% to 0, but if they're not falling to negative 20%, then you're not going to get the same return from that same strategy.
Yeah. So okay, fair enough.
Yeah. Overfitting is another one. Now the overfitting is it happens right throughout. Any of these quantitative models can easily be, you can get these fantastic return profiles that show, if I had bought this type of company and that type of company and done it in whatever measure, I would have generated this great return and almost no risk and things like that. And generally I go, well, that's great. As soon as we get a time machine and we head back to 1980, that's what we're doing. We're buying low volatility stocks or whatever. You need to come back and go, well, have you just fitted it to the time period you're playing on? and so the machine learning type of quantitative strategies are very much in that factor, is that they're you need to be really careful with them, that you're not just I'm coming up with a perfect combination of stuff I should have done.
Yeah, that's right. Yeah, using a historical rule set for future opportunity. Okay, makes sense.
But that whole self-serving bit, is just more about the that everything good is my fault and everything bad is somebody else's fault. And then reversals is the other one. So is that if you're say in the momentum area, is a it's a strategy that reverses quite quickly. So you're buying these stocks that are going up because they're going up, and that's great, and you're doing really well out of it. And then all of a sudden, though, when it turns, it's sort of it'll all disappear.
Yeah, the bottom just falls out.
Exactly.
Okay.
And so if you're making a bet on, is that what I was saying at the front? If you're making a bet on no mean reversion, you need to be sitting there watching the whole time to say, okay, is there mean reversion? So
when am I getting out?
Which is why most momentum traders have these stop losses.
Yeah,
they're saying the only reason I bought this is because it's going up, and so when it stops going up, I just need to make sure I'm out with the stop losses.
Yep.
And that's where, and the quality one needs to be thought about in the same way as saying, look, I'm only buying this stock because it's high quality. So I bought it if it's it's average value, and I've only bought it because it's high quality. We need to be sitting there the whole time going, is it still high quality? Is it still high quality? And so a stock like Apple is a great example of one which not particularly expensive, looks very high quality in a whole bunch of different measures, and so we've got it in the portfolio. It's one of our biggest holdings, and it's done very well. But we're sitting there the whole time going, are you going to be the next BlackBerry? Are you going to be the next Nokia? You just need to. The whole time is a focus on I'm happy to own it, but my focus is is the quality going to change?
Yeah, sure.
Yeah, and am I looking too much at historical and not enough at future?
Yep. Okay. All right, fair enough. And then moving into
Different
the sectors,
yeah.
And look, obviously this would be a pretty major component, I would have thought, of the quant methods, as you sort of said a couple of times there, where essentially what works for some companies and sectors and markets absolutely doesn't in others.
Every measure you need to work out, am I looking, should I be looking at this measure versus everyone? Should I be looking at, often we generally use versus everyone excluding banks. Okay. Or we have our own subgroup of companies. It's sort of like sectors, but it's a bit of a mixture of sectors and business models, because there's ones where you go, okay, this company's in the oil and gas sector, sure, but there's a wide range of people within, whether you're drilling, whether you own the assets, whether you've just got royalties on it. There's a whole bunch of different business models within it. So it's basically a mixture between what business model does the company have and what it is, and those business models can change. So we saw IBM. Yep. All the stats from IBM we saw before was because IBM changed from being very capital intensive to very service, and so all its ratios changed, and it needs to be sort of kept away in the background. So sort of the key ones are looking resources, utilities, financials, and then manufacturing versus services are the key things to tend to look at. But there's lots of other sort of nuances in terms of making sure that.
And we used before the example of Apple. Now, obviously, Apple, I guess, essentially started as a manufacturing, kind of in the same vogue as an IBM, and now, obviously, with all the different Apple services and various streaming and all the rest of it that they're doing. So they're a quasi, are they still, or do you think they're going to ultimately move to a services only, or
they're in with a number of other companies, and something like Boeing actually is almost in the similar type of factor in that they've outsourced so much of the production that they're basically an intellectual property. I treat it as a sort of an intellectual property component to it. Sure. In that they're sitting there telling other people, this is how to design it, this is how to do whatever, and we'll be the ones who put it together, or even we'll outsource it, but we're not sending it to one person.
Project manager as opposed to owning the whole manufacturing chain.
Exactly.
Okay.
Yeah, and so so it's absolutely a question about how much of it's intellectual property, which is one of our sort of classifications we use, and how much of it's not. And that actually that type of classification also jumps in for I find it very useful in the healthcare sector, is that some healthcare companies have a great distribution network throughout all the doctors and things like that about getting their drugs through them. Yep, sure. And so when we buy them, we're not really buying the drugs, if you know what I mean. We're buying the distribution network, and because they can just go and buy the next drug and stick it on the end.
They'll license it, and then they just they've got their channel. Yeah, right. Fascinating.
Whereas other ones, all they own is this patent, and that's the key. And so that whole business model and knowing what you're buying is very key to me. Is that knowing, have I bought somebody who only owns a patent and doesn't do any manufacturing? Okay, now that's an intellectual property type of company. Yep. Have I bought a generic drug manufacturer who effectively doesn't own any IP because there isn't any IP, and effectively is just a manufacturer? Yep. Or have I bought somebody who's actually got this distribution network into all these different places? And so important to make sure you're lining up versus the right comparison. Okay,
fantastic, and a nice one to finish up on. So wrapping up, as you said at the start there, and I think it's come through very clearly, that this is a toolkit, and quant methods the spanners in the toolbox. They're not the one size fits all sort of.
Yeah, none of this is carved in stone. I'm always very concerned about ones where it spits out of stock. You say, well, just give me one stock, give me your quant model, and give me one stock, and I'll go run away and buy that. And saying, well, no, these quant models work on average. Sort of, if you can get 55-60% hit rate, and certainly limit the downside, you'll outperform the market by a decent amount. And so if that's our target, if you say, oh, give me one stock and rush out and buy it, it's saying, well, you got a 55-60% strike rate on whether that one's going to be the one that goes up or not.
Sure. Okay.
Yeah, and then the key ones then, just accounting standards are changing, and there's a big accounting standards change. Sorry, let me try that again. There is a big accounting standard change coming. So balance sheet, off-balance sheet liabilities are about to come on balance sheet.
Okay.
And that's going to make a massive difference to everyone's debt profiles and balance sheets and assets. And there's going to be a whole raft of changes. And so your quant model needs to, you can't just go, well, I built this 20 years ago and that's what I'm using forever. It needs to adjust and account for those things. And just that final bit is, keep in mind that, so with our quantitative our quality measures, all we're trying to do is find out how good quality is this company, and can we rely on the earnings to be stable and earn good returns. It's important never to lose track of that as get lost in back testing and, hey, this worked really well, and then from 1990 to 97 this would have been the best performing strategy, and all these things like that. Is they're saying, well, in the end what I'm trying to do is find high quality companies at a reasonable price.
Yep.
And with the belief that if I can do that, then we're away. Yep. That's going to provide the performance for us. And so don't get caught up in the back testing and what worked and what didn't work. And especially when, I often see people comparing back to the MSCI quality index, and we've just shown it's such a very simple index using 3 flawed, very simple calculators.
Yeah, sure.
For it. Quality is more than just a quant metric. It's
not just a set of levers that can be pulled and the right answer falls out essentially every time. So okay, fantastic.
And keep in mind those BlackBerry and Nokias looked good quality all the way down.
Yep. Fair enough.
It was all backward looking, and analysts weren't cutting their forecast fast enough.
Yeah, sure thing. Okay, wonderful. Well, and great one to finish up on. So, on that note, we'll if what you've listened to today piques your interest and you'd like to involve or get the power of quant investing with the Nucleus Wealth method into your portfolio, stay tuned for some information about how to invest with us.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
So I hope you enjoyed today's presentation on Quant Rocks for picking stocks, the quality edition. And of course, we will be running our next webinar, same bat time, same bat channel next week. We've entitled it The March of the Red Dragon. I'll leave it up to you to have a think about what that means. But it is Thursday the 21st of June at 12:30 p.m. And if you'd like to register your interest, as always, head over to proton.nucleuswealth.com so we can keep you abreast and send you any info relating to that webinar. We are also, as always, available on iTunes and Podcast Addict or any reputable Android podcast app that you might have. Just search for Nucleus Wealth or Nucleus Insights to get the history of our of what we've put out for you today, and also any new ones. And just finally, thanks for attending. And as always, we will be sending out our survey where you can give us a bit of feedback on how we've gone today, and also put up any topics you'd like to hear about or for any future webinars as well. So on that note, thanks very much for viewing today. I hope you got a lot out of it. I certainly did, and we'll look forward to catching you at the next one. Cheers.